Neelkanth Mishra joining in now. He's Chief Economist, Axis Bank, and Head Global Research at Axis Capital. Neelkanth, thank you so much for coming in. And I'm glad that we're speaking to you after there has been some time to digest what has happened. Look at the fine print and understand if this was a budget that didn't quite move the needle, or are we right now unable to really comprehend what vision has been laid out?
The budget was, I think, completely predictable, and I mean it in a very good way. For the government to help bring down long-term cost of capital, the reduction of policy uncertainty is a very important factor. And therefore, the government announcing a medium-term consolidation path and then sticking to it is the most important thing. And to achieve that without any dramatic changes to taxation, by maintaining the quality of expenditure at a very healthy level, I think all of these are very positive developments. Therefore, the budget for me was as expected, and that by itself is a big positive. If I was to highlight a concern that emerged, which is where I think the conservativeness that the government has used in projecting a nominal GDP number or the tax projections, I think the extension of that on the financing of the deficit. So if say 17 lakh crores is your deficit, how do you finance that? And I think the assumptions made in that are at risk of undoing the remarkable fiscal discipline that we have seen. So there are some assumptions made which actually make no sense to me, or very little sense to me. And as a result of that, the gross borrowing target has turned out to be higher than what the bond markets expected, and yields have actually gone up when they should have been going down.
Just to double down on that point, Neelkanth, is the fiscal math not sitting right? And where really now is the room for this government to meet its targets? Because that's been the track record so far. Would you likely see more divestment coming in, the RBI coming in to help out? How does the math really add up?
So this is a two-step process. So the first is the fiscal math. I don't see a challenge with the fiscal math. In fact, by assuming 10% nominal GDP growth, I think 10.5 is possible. By assuming a fairly decent tax to GDP, I think that an improvement is likely in the coming year. I think the government has adequate buffer. So even if there is a significant slowdown in the global economy, perhaps even a war which pushes up oil prices, I think there are some buffers that exist on the fiscal math itself. The challenge I was flagging was on what happens after the deficit. So it's like, you have 17 lakh crores of deficit that is budgeted for this year. How are you financing that? How much are you getting from small saving schemes? How much are you getting from T-bills? How much are you getting from bond issuances? How much is coming in through some other funds? Now, these other funds, which contributed 76,000 crores in FY26 or expected to, there is a drawdown of nearly 45,000 crores in FY27, which itself is like a swing of 1.2 lakh crores. On top of that, I think in small saving schemes, the government has assumed in FY26 a 13% decline. So we were at about 4.2 odd lakh crores of small savings inflows in FY25. The first 9 months of this fiscal year, we have seen a 32% increase year on year. But still, for the full year, the government has assumed a 13% decline. Now, given that a large part of those flows occur in the month of March, it is possible the government knows something that we don't, but it's very unlikely that those flows, the momentum or the growth can change so dramatically because the small savings rates are not being mended anyway. So that by itself, and then on that base, the low base, they have assumed only a 4% growth in FY27. So that itself is like a 1.2, maybe even a 1.5 lakh crore swing. And that will actually, if done properly, that would have actually given comfort to the bond markets and helped bring down yields. So remember that with 5.25% repo rate, a 10-year bond yield at 6.75 when we are approaching the end of the rate cut cycle is a ridiculously high yield spread. That should be closer to 50, 60 basis points, not 150 basis points. So that's the point I'm making. It's not about the accuracy of the fiscal math or there is a stress point there. What I'm saying is the financing of that deficit through various channels, I think the assumptions made are too conservative. It is quite likely that the government will again end up with a very large cash balance, which then creates more disruptions in the financial system.
Neelkanth, important points that you're raising, and good morning, this is Alex here. I just wonder whether certain aspects, like for example, that divestment target at 80,000 crore rupees, we've seen in past years that they failed to do that. And so whether it gets balanced out, the point that you were just making, or whether, and you've obviously studied all of the numbers, so you probably know this, the couple of line items which are unlikely to meet that target, which we've seen in the past, if that does happen in FY27, is there still going to be room?
Yeah, so again, disinvestment appears what I would call above the line, meaning that it is accounted for in the fiscal deficit target itself. So just for perspective, so there is an 80,000 crore number for privatization, which I think is for me, I mean, there is an opportunity to do a lot more than that. But anyway, this is what the government is targeting for this year. Suppose there is a slippage of 30,000 crores. You know, the RBI dividend they've assumed is, I think, about 2.7. They don't break it out, but the non-tax revenue going from 3.75 to 3.93 is barely any increase. In fact, given how high US yields are and what seniorage income for the RBI can be, it's very likely that RBI could actually itself do 3 lakh crores this year. So that extra 30,000 crores can be offset from that. So forget about tax revenues, where I think the government has been excessively conservative. Even on the non-tax side, there is adequate buffer that has been built in, which is very consistent with this government. That you do a fiscal math which is achievable, be very conservative. The point I'm making is below the line. So the disinvestment and privatization is above the line. The below the line number is where I think their excessive conservativeness is potentially undoing the benefits of fiscal discipline.
Point. So therefore, let me ask this. If what you're saying actually results in the RBI looking at it maybe mid-year and saying, or the government looking at it mid-year and saying that the borrowing target for the full year will have to be adjusted lower, or might have to be adjusted lower, would that imply that at that point you'll have a significant softening in the bond yields, which have hardened not just overnight, not just today, but have actually been pretty high over the course of the recent past?
Agreed. And let's first understand the reason why the yields have actually shot up in the past 1.5 to 2 months. It has been because the liquidity in the overnight markets has been very unpredictable. So there is if your 12-month CD rate, the certificates of deposit for a bank, is at 7%, and your 10-year bond is yielding 6.6, and you have it and you have some excess SLR, the banks have been shedding it. So what we flagged in our note is that the bank's share of incremental bond demand in FY26 is likely to be the lowest on record, because banks at the margin have been shedding because of persistent uncertainty on liquidity. So addressing that actually, because look at situation before December and after the rate cut, right? 5.5 went to 5.25. The marginal cost of borrowing for financial firms has actually gone up. So bond yields have gone up, the CD rates have gone up. So this is clearly a liquidity and a quantity of money problem, not a cost of money problem at a repo rate level. So this is something that does need to get addressed. So, but this is not a fiscal challenge by itself, if you see what I mean. I think the government has ticked all the right boxes on the fiscal side. This is about operationalizing the borrowing math and trying to keep or translate the fiscal discipline into lower cost of borrowing.
Got it. Neelkanth, one view was that this, and good morning, Neeraj here, this 17.2 lakh crore gross borrowing number that has come in, could, and because there is some RBI maturity happening, could a switch have been announced? Could it have helped make the gross borrowing number look a lot better optically as well, if you will? And could that have assuaged bond markets a little?
So that has actually that is the issue. You see, if you go deeper into how a switch works, the switch. So every year, the government has some switch, meaning that it will suppose there is a bond maturing next year, so it will buy that bond. And then issue in its lieu a bond with a, say, 10-year maturity. So the duration keeps getting extended. So just for example, in Jan 25, there was 7 lakh crores of bonds maturing in FY27. In Jan 26, that number had dropped by 1.5 lakh crores. So that's how the switch works. Now, the government had guided to 2.5 lakh crores of switches in FY26, but they did only about 1.6 lakh crores, which means that the bonds maturing in FY27 are about 1 lakh crores higher than perhaps what was necessary. So these are, as you can imagine, these are at the margin. I mean, at least for a non-bond market expert like me, seem like bal ki khal, as they say in Hindi, but clearly these matter to the bond markets, and given that it is the bond market that sets the rates, I think managing these expectations, setting the targets right, or what is the need to have the average maturity of government debt at 13.2 years? Most large economies have it at 7-8 years. The US, of course, not a shining example of fiscal discipline, is at 5.5-6 years.
Got it.
So these are things that I think also need addressing. So
hopefully
the government
soon
is doing all the right things on the fiscal side, but I think on the nature of borrowing, I think there's a lot more that needs to be done.
Neelkanth, we have a corporate waiting, so I'm gonna take one last question and we'll shift it completely to equities. The equity markets haven't, I mean, the capital markets per se haven't quite gotten anything dramatically positive in this budget, right? Yields only add to that pressure. What do you think happens for the better part of 2026 for equity markets, if you can make it quick, Neelkanth?
Sure. I think the fact that the fiscal headwinds have eased should actually be good for the economy. Most people have this mistaken assumption that government was somehow supporting growth. There's some senior economists saying that as well. I totally disagree. That in the last 3-4 years, the government was supporting growth, and it no longer can no longer support growth. It's actually the opposite. The government was a big drag on growth. It's no longer a growth, and therefore the drag on growth, and therefore the realized growth can actually be faster in FY27. As the evidence of that comes in, as the pace of earnings cuts reduce, I think the market should see some solace going forward.